I'm the Tax Geek, with more of your taxes oversimplified. This is the third video in a series on taxes for landlords and tackles the subjects of depreciation and amortization. I'll start out by saying depreciation is a complex subject that cannot at all be completely described in a short video. This video is designed to give you a very oversimplified overview of depreciation, particularly as it affects rental properties. Hopefully, you'll gain a broad understanding of the subject, and if you don't, feel free to watch the video again. And again. Depreciation is a process where the cost of long-lived assets is spread out and expensed over the approximate useful life of the asset. Accountants have many depreciation methods they can choose from, but the IRS has mainly one: the Modified Accelerated Cost Recovery System, which in its acronym form is called MACRS. MACRS establishes standardized asset lives and depreciation methods for each broad class of asset, eliminating a great deal of guesswork. Depreciation only applies to assets that lose usefulness over time. The only asset that doesn't lose usefulness over time is land, so land is never subject to depreciation. Notice I said lose usefulness and not value. Especially with regard to buildings, it's very possible for a building to increase in value but lose usefulness as it ages. That is why we depreciate buildings. So let's see how depreciating a building works. You start with the building's basis, which is the purchase price of the building plus any closing costs and the cost of any repairs or improvements you make to the building before it is placed in rental service. We now have to determine the building's useful life. MACRS makes this easy for us by assigning a 27.5-year asset life to residential buildings and a 39-year life to non-residential buildings. We then have to choose a depreciation method. Again, MACRS makes it easy for us by using a method called straight line for all buildings. As you can probably guess, this means the depreciation is spread out evenly through the building's useful life. So the annual depreciation expense for a residential rental property is 1 divided by 27.5 for each full year the property is in service. This works out to roughly 3.6% per year. If the property is in service for less than the full year, depreciation starts or ends in the middle of the month the property enters or is removed from service. Time for an example. You purchase a residential property you intend to rent out. The purchase price of the property, including the land, is $175,000. You pay closing costs of $8,300. By examining county tax records, you find that 30% of the total assessed value of the property is the value of the land. So $52,500 is land value that cannot be depreciated. 30% of the closing costs, or $2,940, must also be assigned to the land. So you start with a basis for just the building of $128,310. But then you spend $15,400 on the building renovating it before you rent it out. That brings the basis up to $143,710. Therefore, for every full year the property is in service, you will claim $5,226 in depreciation expense on your Schedule E. If you purchase the property in May and put the property in service after the renovations were completed in October, you would claim depreciation from October 15th, which is 2.5 months of depreciation, or $1,089. But what if you make major improvements to the property at a later time? The cost of these improvements would be depreciated over a new 27.5 or 39-year asset life. Landlords often purchase other types of long-lived assets, such as appliances or carpeting. These assets are still depreciated using MACRS, but with a much shorter asset life, usually 5 years. I won't go into all the math, but 5-year MACRS allows you to take more depreciation in the first few years you own the asset and less in later years. Since you take 1/2 of the yearly amount of depreciation in the first year you own the asset, this means an asset with a 5-year life is depreciated over 6 years. This is also calculated for you in the table. This is how the annual maker's depreciation is calculated for a $3,200 carpet installation. Currently, bonus depreciation is available. For 2021, you can depreciate any asset with a useful life of 20 years or less 100% in the first year. This bonus percentage remains at 100% until 2023 and gradually reduces until 2026. Bonus depreciation is currently the default method of depreciation unless you elect traditional maker's depreciation. But for assets with a cost of less than $2,500, you can avoid depreciation entirely. The IRS has a safe harbor rule that allows you to write off the entire cost of the asset in the year you acquire it. This is usually the best option for most landlords since it eliminates the need to keep records of the smaller assets you purchase. As mentioned in the rental expenses video, if you paid a loan acquisition fee, or points, upon obtaining a mortgage, those fees are spread out over the life of the loan in a process called amortization. In that video, William paid $2,900 in points to obtain his 30-year mortgage. He would then divide the $2,930 in points by the 30-year loan life, resulting in $80 in annual amortization expense until the loan is paid off. Fitting the basics of depreciation and amortization into about 1,000 words was tricky, and there are many more details and rabbit holes you can fall into on this subject. Links to additional information and details, including IRS Form 4562, which is used to report depreciation, are in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please feel free to review any part of the video you do not fully understand. You can also direct any questions, comments, or suggestions to the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.